A lot of people were talking about Thrive in 25 last year. Now we've been hit by a lot of uncertainty. We've been hit by a lot of question marks. And I don't see that uncertainty stopping anytime soon. But I think what we're doing is we're building a little bit of pent up demand. And once we see a little clarity in the economy and a little clarity in where things are headed, I think we'll see that pent up demand release and we'll see some really strong growth.
All right. Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we have joining us today Craig Hurvitz, who's our National Director of Industrial Research. And Craig's been on our podcast a couple times before, always does a great job. And given that we're halfway through 2025, we thought we'd have you on and talk to you a little bit about what's going on nationally. First half of the year, obviously, there's a lot going on. So maybe we can start with that, Craig. Just give us an overview of, big topics over the first half of 2025.
Yeah, thanks for having me, guys. I'm always happy to join. It's great to be on this podcast. We don't have all of the data in Q2 yet, but it's looking like the indicators that I track nationally, they'll likely play out much like they did for the first quarter of 2025. So tenant demand, which we measure by net absorption or the net change in occupancy from one period to the next, it totaled about 35 million square feet in the first quarter of 25. And while that figure may drop off a little bit in Q2, it will be the 60th consecutive quarter that net absorption has been positive in the US. So that's 15 years of occupancy gains going all the way back to 2010. So really, it's been an up industrial market for quite a long time. Now, one matter of concern that I wanted to bring up is that move-outs are up, especially in smaller spaces. Looking at the preliminary data for the first half of 2025, many markets are reporting negative net absorption, particularly in spaces and buildings below about 100,000 square feet. Now, that's just kind of a new development, so that will have to be monitored to see if it's a real trend or if it's just a momentary blip. So vacancy will increase for the 12th quarter in a row. It's been climbing from a low of about 3.5% in the middle of 2022 to now it's over 7%. The good news is that it has been climbing more and more slowly over the past several quarters. Strong speculative new supply was pushing vacancy up over 50 basis points in 2023, but that construction pipeline has dropped by over 60% since then to levels that are actually below pre-pandemic construction figures. And vacancy is nearing its cyclical peak. So when you actually break that vacancy rate down by building size, it's the highest. It's over 10% in buildings over 200,000 square feet. But that's really because that's largely what was being built during this recent development boom that we're now coming to the end of. Moving on to rent growth. Rent growth is stabilizing.
Before you move on to that, I'm curious, because on the West Coast, at least, there's a lot of problems around that 200,000 foot size range. So I'm curious if you have the statistic or maybe just off the top of your head, how does that change when you get up above 500,000 feet?
So that size range is actually pretty interesting because when you pull out buildings 500,000 square feet and above, really your mega sized buildings, that vacancy rate peaked actually about a year ago at about just over 12% nationally. Mm-hmm. And it's fallen off since because developers aren't building those really, big bombers anymore. And there's been some leasing volume in that size range. And it's dropped to about 10.2% since then.
Interesting. And tell us, overall, what are the markets that are in trouble? I think last we spoke, Dallas and Phoenix came to mind on cities that were in trouble. So what are the soft spots? What are the hot spots in the country?
Yeah, so I like to look at year-long trends or year-and-a-half-long trends to really kind of make that comparison because looking at quarter-over-quarter trends, there can be some bouncing around a little bit. But when you really look at the grand scheme of things, U.S. industrial markets have bifurcated a little bit. Some markets are stabilizing, particularly in the Midwest, while vacancy has climbed into the double digits in others due to supply side pressure and a pullback in demand. Demand has actually exceeded new supply in several markets over the past year, pushing vacancy down. These markets include Chicago, Kansas City, Omaha, Salt Lake City, and Savannah. Now, in others, the balance between supply and demand is still off. Net absorption has been negative over the past year in these markets, while new supply continues to deliver. Examples of these markets include Charleston, Memphis, the Bay Area, Sacramento, Portland, Oregon, and Reno Sparks. And you'll notice a lot of those are actually on the West Coast. But even in these markets that are a little bit softer, new supply is falling off, and that equilibrium between supply and demand is returning, and vacancy is approaching its cyclical peak.
When you go to those major markets that are soft, if you have the list there or off the top of your head, what are some of the major cities in vacancy trouble? And what percentage are we talking about? I think last time we talked by memory, and I could be wrong, but Dallas and Phoenix were double digit and growing. So I'm just curious kind of where we're at from the major city perspective, not secondary.
So I published a report that we call the Markets That Move America, that looks at the 25 largest U.S. industrial market, kind of compares it to the overall U.S. industrial market, and then the other markets that aren't considered the top 25. So when you really splice out those 25 largest U.S. industrial markets, vacancy's highest in Phoenix at about 13.2%, Indianapolis at about 11%, Memphis at about 9.4%, Dallas is up there above 9%. Then you have Atlanta at about 8.8%. And those are all Q1 numbers. We just don't have the finalized Q2 numbers yet. But those are all, pretty well above that U.S. average of about 7.1%.
Yeah. Dallas has improved, actually.
Dallas has improved. Dallas has seen things kind of stabilize a little. We've seen a little bit of demand come back. And at one point, we were, Dallas was building over 65 million square feet.
Crazy.
And most of that was being built on spec. And now that's dropped off, about 70% from its peak.
So, Craig, you talked about the highest vacancies. What are some of the tightest markets, and maybe the top 5 in the U.S. On lowest vacancy?
So again, looking at that top 25 markets, the 25 largest U.S. industrial markets, vacancy is well below the U.S. average in several, particularly in the Midwest. It's lowest in Cleveland at 3.1%, Minneapolis at 4.3%, Detroit at 4.7%, Chicago at 4.8%, St. Louis at 4.8%. So each of those top 5 markets, in terms of lowest vacancy rates, they're all in the Midwest.
That's crazy. And Chicago really surprises me, being that tight.
Chicago peaked at just around 5% a few quarters ago. Luckily, their construction pipeline has fallen off significantly, and they've actually seen a pickup in leasing volume and demand. I think for the second quarter, Chicago's reporting about 5.1 million square feet of net absorption, and they saw a lot of big leases signed in Q2.
How about subleases? For a while there, we saw just a huge increase in subleases hitting the market, which can be problematic for landlords trying to lease their space, now having to compete with subleases. Are you seeing any sort of trends? Is that slowing down at all, or are we seeing more subleases hit the market?
So that's one metric that I follow pretty closely, because it's one of the first to flip. That is a signal that the market is moving on to its next stage in the cycle. There was hope about a year ago that we had seen sublease availability peak nationwide. We saw it kind of come down. I think it was the first into the second quarter of 2024. And I was hopeful that that trend would continue. But then we saw a number of larger subleases hit the market, particularly Home Depot put a number of buildings nationwide on the market for sublease. And we saw that sublease availability increase once again. Now, it's still elevated, but it's no longer climbing like it was. It's just kind of hanging out at an elevated level. Hopefully that starts to come off in the next few quarters. And again, that'll be a signal that we're starting to see that shift that we're all hoping for going into the end of 25 and into 26.
Going back real quick, by the way, subleasing, it seems like every single day in our Seattle market, there's 2 or 3 new subleases coming out.
Yeah.
It just continues to go bonkers.
Okay.
So hopefully
that's interesting.
It really is. I mean, we have.
Are you seeing some come off the market too, or like some
barely? Because the issue with subleasing, as I've said in the past, is the companies that normally absorb subleases are 3PLs, because they have a contract or they have overflow, right? So they're usually seeking shorter term space, and for overflow. But in this market, it's the 3PLs that are the culprit or that are giving them back. So it's a double-edged sword, right? Not only do you not have the 3PLs to pick up that space, 3PLs are contributing to it. So it's building quite rapidly. And to the point where I think it was about 2.5 years ago when we started really tracking the changes. And there was about 600,000 feet of subleasing when we started tracking it. There's about 6 million feet now. Like, that's a big change, right?
That's a big change.
Yeah. So I'm sure some are being picked up, but it's being outpaced by a massive supply of it coming online.
Right. Like I said, it's still elevated. It hasn't come down from its peak. In many markets, it's still climbing, but it's just not, at least compared to your anecdote about your market, I'm not seeing it as many markets climbing at that pace that you're seeing out your way.
So, Craig, let's talk about the biggest industry changes that we're seeing from an absorption standpoint across the U.S. What industries are growing?
So, the past several years, it's been pretty consistent. Third-party logistics providers, trucking and transportation companies have represented more or less about 1/3 of the bulk occupiers, which are 100,000 square feet and above. And that was consistent for 2024, and so far is consistent in 2025. It's interesting if you actually split that group out. So split out all the 3PL providers, the trucking and transportation companies, and you look at where they're coming from. In 2024 and through the first quarter of 2025, about 27% of those 3PL companies were Asian-based. That's a big change and a big trend that we hadn't seen before. And that's nationwide, looking at bulk occupancies above 100,000 square feet. In some markets like Philadelphia, Savannah, Greater LA, Atlanta, that's above 40% of the 3PL occupancies that are taking place are Asian-based 3PLs, which is really a notable trend. Following 3PL providers, you have manufacturing representing about 14% of the bulk occupancies, general retail and wholesale at about 12%, food, beverage, and pet supply. And then much smaller segment is e-commerce at about 5.3%. Amazon, we did see a push in 2024, but it wasn't like the push that they did in 2020 and 2021 when e-commerce represented about 15-20% of the new occupancies that were occurring nationwide.
Well, this has been really good information. Last item. So any other trends that you want to touch on or predictions that you see for the remainder of 2025?
So construction activity continues its downward trend, and that's great news for the market, especially as demand has dropped off. Now, demand remains positive, but you want to see your construction pipeline and your new supply figures fall off in a market where demand is a little bit lower than the averages that we saw prior to the pandemic. Manufacturing construction spending has actually surged over the last few years. It's up about 212% since 2020, but It's leveled off in the past year. Now, warehouse construction spending, especially from the private sector, it peaked in 2023, as we all experienced, but it's since normalized to pre-pandemic levels. Now, the big number that stands out is data center construction. Data center construction spending has just continued to accelerate. It's up 32% year over year, and it's up a whopping 300% since 2020. I want to reiterate, this is not a down industrial market. It's a segmented one. The coming year will be marked by recalibration instead of the rapid growth that we experienced in 2021, 2022, and 2023. The markets that are stabilizing or even where vacancy is starting to fall back off again, they'll lead the next upcycle. While those where vacancy is well into the double digits and new supply continues to be a bit of a concern, although it's likely falling off, those markets will face a slower recovery. So it's a segmented industrial market. Some markets are, ahead of the game, and some markets have a ways to go. But I do anticipate by the end of the year that vacancy will peak right around 7.5%. We'll see that equilibrium, that balance between supply and demand return, and we'll see, we'll be slowly moving towards that next growth cycle. Now, a lot of people were talking about Thrive in 25 last year. We've been hit by a lot of uncertainty. We've been hit by a lot of question marks. And I don't see that uncertainty stopping anytime soon. But I think what we're doing is we're building a little bit of pent up demand. And once we see a little clarity in the economy and a little clarity in where things are headed, I think we'll see that pent up demand release and we'll see some really strong growth.
Excellent.
Well, excellent information as always. It'll be a very interesting second half to the year and great intel on the first half. So thank you for sharing your insights on that, Craig. Appreciate it.
Hey, guys, thanks for having me. I really appreciate it.
Great to see you. Appreciate you.
All right, guys.